Good morning, good afternoon, good evening, everyone. Welcome to session 2 of our webinar series on practical risk management. My name is Ali Mortazavi. I'm the head of education at Errante. I'm thrilled to have all of you here today. So if you attended the first session, you already have a solid understanding of fundamental risk management principles. But today we are taking things up a notch. This session is all about advanced techniques, let's say more practical techniques or strategies that professional traders use to manage risk effectively in dynamic market condition. Let's be honest, most traders focus too much on profit and not enough on risk. But here is the reality. Managing risk correctly is what separates successful trades from those who blow up their account. So it's not about how much you make in one trade. I would say it's about how well you control your losses and protect your capital over time. So in today's market, where volatility is constantly shifting, a fixed approach to risk simply doesn't work. So we need adaptive, data-driven techniques, and that's why we have this webinar together today. I hope by the end of this session, you will have a clear professional grade risk management plan, or at least you will have some idea how to make this plan for yourself, and that you can implement immediately on your demo account and then on your real account for sure. And you will learn how to assess whether a trade is worth taking, and most importantly, how to minimize drawdowns while maximizing long-term profitability. So that's it. If you're ready to take your trading risk management to the next level, let's dive into the first key concept: optimizing the risk-reward ratio based on market condition. Before that, let me make it clear that this webinar is brought to you by Errante, which is an online broker, and you can find us almost everywhere. This is an award-winning broker. We have multiple, let's say, the trading platforms like the MetaTrader 4, MetaTrader 5, and also the Trading View and CTrader, and all of them is somehow precisely advanced in some part of trading. So these platforms can just meet the needs of all different types and styles of traders. However, everything we are discussing in our webinars are solely for educational purposes. Don't take them as the financial advice of any kind. By the way, we know the CFDs products are really risky. Almost 42% of retail investor accounts lose money when trading CFDs with this provider, means Errante. So that's it. Let's move on and start our webinar right here. Okay, why are advanced risk management techniques essential? In our last session, we laid the foundation for risk management, how to measure, analyze, and control risk. But as you probably realize by now, knowing the basics is not enough to survive in the markets. It's time to take things to the next level. So have you ever placed a trade with a stop loss and felt confident, only to watch it get hit and then see price reverse in your favor? Frustrating, right? Correct me if I'm wrong. This happens because most traders use static risk management techniques. They set a fixed stop loss, for example, 10 pips all the time, and a predefined risk to reward ratio. We call it RRR for every trade, assuming that's enough. And they said, okay, I have a very good RRR, so I'm gonna be profitable. Or I'm always watching the even support and resistance levels, the previous tops and bottoms in the market, so I'm gonna be okay to take every trade. But the markets are not static, so they are constantly shifting, reacting to news, liquidity changes, and trader sentiment. You see here the first thing, one size fits all risk management approach fails in volatile markets and underperforms in ranging conditions, particularly. So to not just survive but thrive in trading, you need a flexible, adaptive risk management strategy, one that adjusts to market conditions instead of fighting against them. So first, we're going beyond theory. I'm going to show you practical risk management techniques that will change the way you approach trading. First is optimizing your risk to reward ratio. Instead of using a fixed 1-to-2 or 1-to-3 risk reward ratio for every trade, you will learn how to adjust this dynamically based on volatility and price structure in the market. And then using dynamic stop losses, we'll explore why fixed stop losses often fail and how to set stop losses that adapt to market conditions, preventing premature stop outs. And the third is position sizing for risk control. You will learn how to adjust your trade size correctly so that you never risk too much while still maximizing profitability. Be honest, how many times has your stop loss been hit only for the market to reverse and move exactly where you expected? I asked this question at the beginning, but if you've experienced this, that means you need to rethink your risk management strategy. And good news is that we are about to fix that. So let's dive into our first key concept, optimizing the risk to reward ratio, RRR, to see how well we can get more insight on this. RRR measures how much risk you take on a trade compared to the potential reward. If your, let's say, for example, your stop loss is 50 pips and your target profit is 100 pips, simply put, your RRR is 1-to-2. This means for every 1 pip you risk, you're aiming to make 2 pips in return. So the formula is very simple. As you see here in my screen, is a target profit divided by stop loss, the distance from the entry, and it gives you the RRR. Many traders stick to a fixed RRR without considering the market conditions. And why is that a problem? We call it a common mistakes in RRR adjustments. The market is not always the same. So sometimes it's volatile, sometimes it's calm. A fixed RRR might not match the market's price action, making it either too aggressive or too conservative. And what is a solution we can have here is that we can adjust our RRR based on market condition. And how we are going to do that, market condition should determine the appropriate or not a fixed number. So let's break it down further to see how to adjust RRR based on market conditions. There is a very, let's say, good saying, in high volatility markets, it means when we see big price swings, a strong momentum, there is more potential for large moves. So we should increase RRR, or we are allowed to do that. Example here is, for example, instead of a 1-to-2 RRR, we aim for 1-to-4 or 1-to-5, and we see we are getting back from a very, let's say, significant key price level, or we see a breakout of a range with a very large body candle. So in that case, we have the right to somehow get our expectations further and higher, to set our RRR a bit higher than what we expected before. So why? Because price can move farther in our favor, allowing for bigger profits. But in low volatility markets, like sideways movements and slow price action, or in a range market, the market moves less. So we should reduce RRR. We have to expect the market can change, let's say, unexpectedly, and it's too risky because in the absence of, let's say, intact trend, we have to be more conservative. So we reduce RRR. In these scenarios, we aim to not losing money, to not lose money. Okay. For example, instead of 1 to 3, we use 1 to 1 even, or 1 to 1.5 RRR. Why? Because waiting for big moves in a slow market might lead to unnecessary losses. A real-world example, imagine a major Federal Reserve interest rate decision is coming out. So volatility is expected to increase significantly. A wide RRR 1 to 4, 1 to 5 allows us to capture a strong breakout move if we have a very well identified technical analysis setup implemented on the chart. I mean, if we understand what's going on in the market, it's not going to it's not going to be something that can just take us out of the water if we have no idea what's going on in the market. Now, compare that to trading Euro USD during the Asian session. So first, you have the Federal Reserve interest rate decisions. For example, during the news announcement, it's very risky to trade, but the market is getting really hit. So compared to the Asian session, the market is very quiet, especially at the end or at the very early beginning of the Asian sessions in New Zealand somehow, or in Japan. So the price moves slowly and in small ranges. These cases suggest us to choose a lower RRR 1 to 1 or 1 to 1.5 can ensure we take profit before the market reverses. There are many examples you can find out on first of all the MetaTrader 4. Let me show you my chart here. You will get the idea what I'm talking about when it comes to choosing For example, when you look at the market, you see and there are periods that the market is very choppy like this. It might sound like a trend at the beginning, for example, this top and then this higher bottom than the previous one, and then we get along with the trend. We see the market just breaks below the previous bottom, and here we might get a sense of a downtrend. But look at these candles. How we can measure the market is too risky or too volatile is that when we see a very large shadows on both sides, or we see candles in opposite colors, one after another appears on the charts. So in that case, for example, see the price has been was decreasing, and then it was rising and then decreasing again, and covered any session in 1 hour session, all the losses or all the profits from the previous session. So in these cases, we better go first very conservative into market. However, as soon as you see the market is really fluctuating, as soon as we see there is a chance to get a breakout of this market, for example, something like this head and shoulders pattern here coming up. So in that case, if we see a high momentum in the market, especially during the overlap time 17. So in that case, we can just put our expectations a bit further. For example, if I use a Fibonacci to put some levels here in the chart, you can see in a very this is a candle during the news announcement. So in a very, let's say, regular times, I just expected the market to fluctuate a bit. So that would be even not further than the 2 to 1 reward to risk ratio. But as I see, we have a news announcement, something big is going on in the market. So I can just put my expectation, you take my expectation further, even to 206.8% of this Fibonacci in the previous swing. It means I can have a 2.5 to 1 RRR. So this is a very good thing. So, but there are some times that there is no volatility in the market. For example, let's say you are a trader, you can measure the height of this range here. For example, it's something just like $15 for gold, about how many sessions? About 20 sessions, 20 hours for whole trading day in this really boring day in this market. So in that case, if you want to trade and for example lower time frame, the first thing you need to keep in mind is not to have high expectation for this range market. You see, we are just hovering in a range. So even if you want to trade a breakouts or even you want to make a very small profits, that will be good. And in these cases, the most conservative scenario is not going further than 161.8% Fibonacci level, which gives us a RRR of below 1.1. It means our risk will be higher than our reward. Why? Because we are in a very choppy market with no momentum and with no volatility. And it's said that it's recommended not to trade such a market because it's too risky. You see, the risk is higher than the reward. So it's better, it would be a wise idea to prevent trading in such a market. So the first thing, so you see we have a different market conditions, so we really need to understand that RRR is not a fixed rule. It must be adapted to market conditions. In high volatility, use a larger RRR. In low volatility, we use a smaller RRR. And market structure and momentum should guide your RRR, not random ratios. Okay, so next, let's see how we can calculate our stop losses dynamically and how we can measure this volatility. It's going to be interesting now that we understand the basics of RRR. One of the most common mistakes traders make is applying the same RRR in every trade. I keep repeating this because I want to make you understand that we need to have a very wide eyes on the market condition. We need to adjust our RRR dynamically based on market volatility. And the best tool for this is, ladies and gentlemen, average true range, ATR. What is ATR and why does it matter? ATR is a volatility indicator that measures how much price moves over a specific period. If ATR is high, the market is experiencing a strong volatility, price swings are wider, and markets usually go in one direction. But if ATR is low, the market is calm and ranging, so we expect price movements to be smaller. So ATR helps us set stop losses and take profits that are aligned with real market movement rather than arbitrary numbers. But the question is, how do we adjust RRR using ATR? We need to adopt our take profit targets based on the level of market volatility. If we see ATR is high, it means we have a volatile market, so we can widen our ROI if we have a solid understanding of the technical picture. So if the market is highly volatile, it has the potential to move further in your favor. Solution is at a higher ROI, for example, 1 to 2, 1 to 3, or even 1 to 4 if it can be applied. However, as an example, let me bring up my chart here again. And for this, let's take a look. You name any instrument you wish we discuss it. Okay, let's talk about the GBP USD. You like it, guys? Okay, we can discuss on GBP USD. So what does it mean? It means, as I said, for example, let's say we have a setup here. We have the RSI near the oversold area, and then we see the market is coming up, making this top, and then making this bottom, and then it's coming up, almost covering all the losses from the past 2 sessions, and then breaking above this top can be combined with the signal from the RSI breaking above 50 level, and this can be an entry signal for some traders. That is, to be honest, is my favorite simple technical setting. And from here, so how we can use the ATR? Easily you can just get the ATR from here. Let me find it. Okay, it has a period of 14 by default. It means it's going to include 14 previous candles in the calculation to get the, let's say, the average volatility of the market. And what does it tell us? It tells, for example, you see in my data window, the ATR value is showing up. At this very breaking candle, we see first the ATR is moving up after 2 consecutive bullish candles from a very deep, from a bottom, and it means the market is moving in one direction. This is a good sign for us. So, and the next one is, if I look at the number is 0.00112, it means it's about 11 pips. So at this entry point, let's see how much I'm going to put at risk from the entry to my stop loss that can be assumed at the last market bottom. It's almost 24 pips. Okay, be patient. I will explain how we can get a good measurement to evaluate if it's okay or not. So by these 24 pips I'm putting at risk, I might expect, when we see the ATR is 11, the 1-1 RRR for the next, let's say, 3 or 4 sessions to be reached, because it shows on average the price is just moving about 11 pips, and now that the ATR is moving up, it means we are moving in one direction. It means the consecutive same color candles are appearing on the chart. It doesn't tell us that it's always a bullish or bearish. The price is telling us, but it tells us we have a persistent side into the market which is picking up the momentum. Okay, and so the volatility is increasing because the market is closing higher than before most often. So it means we are getting momentum, so we are going into a rally or something. So when I expect about the 25 pips for my profit and the ATR is 11, it means I'm gonna reach it in 3 sessions or 4 sessions if everything will have not changed. Okay, so this is how, for example, this is how we, let's say, implement the ATR, and how we can, now I guess you should have a sense how to compare your trading setup with the ATR. How can you expect to set let's say your expectation for, and also your risk, let's say, appetite. For example, let's say in such a market like this, which is as soon as the market is getting more choppier, you see the ATR is decreasing. So this is a nice illustration of a range market when we see the candles coming up, going up, coming down, going up, coming down, and you see the ATR is decreasing because the market is out of momentum. So in these scenarios, if you see a candle is trying to break above this level and the ATR has not been picking up, it means it's really dangerous, because when you see the ATR at this level is about the 8 pips. So if you want to set your stop loss at this level, it means you are going to take about the 12 pips at risk. But with 8 pips, it's really risky, as we see the ATR is decreasing or is dropping to the south. But before we see any confirmed breakout in any side, we need to see first the ATR is coming up. And this is a very optimal setup for GBP USDs. From my experience, I've been using this for a while, and you can measure the market momentum using the ATR to set your expectation. And in this case, when I see the momentum of the market is decreasing, if I open a, for example, by mistake, a buy trade here, when I see the RSI is on the near the overbought area, so I should not expect the price get much further. So I need to be very realistic about my TPs. As you see, for example, here I can expect only 8 pips for the from the breakout. It gets only 8 pips higher, or let's say less than that, about 7, while the ATR is 6. So you see, the ATR is almost telling us the truth, and it's a very good tool to measure the volatility. And when it's picking up, it means the market is getting momentum, so I can set higher expectation until I see the peak in the ATR. That means, okay, that would be a case to think our let's say exit plans. So if you see the ATR is picking up and market is getting more volatile, so we can increase or put our expectations higher, or increase our RRR. If not, it's better to lower that. But how we can evaluate such a thing, evaluate our stop loss and TPs using ATR? Okay, applying ATR to stop loss and take profit calculations. Now, let's get into the formulas traders use to calculate dynamic stop losses and take profits based on ATR. As you see here, the formula for calculating a stop loss based on ATR is stop loss distance should be a multiplier times by the ATR value. It means, for example, your stop loss should be about the 2 times in distance from your entry price. It's usually 1.5 to 3 times ATR, depending on market condition, depending if on the ATR, if it's coming up from a trough or it's not. So a higher multiplier is used for trend trades, while a lower multiplier works better in ranging markets. So the formula you see here, multiplier, and this multiplier should be 1.5 or 2 till let's say up to 3, and that would be cool. It means if you see a setup in the market and it suggests you the stop loss distance less than the ATR, it's better not to take that trade, because it means the market is that volatile that any natural movement in the price or this let's say fluctuations can hit your stop loss easily. So it means it's not a good choice to set. For example, if I want to open a trade above this level and I see this is about the 20 pips, and then if I look at the ATR, I see it's a 15 pips, it means it's really risky. So it means on average, market can be down by 15 to 20 pips and then goes up. So it means my stop loss will hit. And if you look at here, you see very nicely the market just reacted to this market button, to this button here, by this shadow, which is something like a sweeping or grabbing liquidity in terms of the let's say money flow analysis, and by this shadow, and then it's started this rally here. So here is how you can define if this is the right setup to enter or not, or if you should take the risk of this trade here or not. And also you see the ATR is almost near the peak. Even if you are in a live market, you will see the market is a bit further higher than its trough, so the ATR. So it means we are getting to the peak, and also you see the RSI is in a good condition. But as soon as we have a correction in the market and we see the ATR is correcting itself, so that would be a good time to enter the market, for example, in the next move here. So use this multiplier from 1.5 to 3. So you take a trade with a conservative RRR if you see, for example, the ATR is low, indicating call market conditions. So this is a conservative RRR. So we don't expect, we are not going to risk a lot. So we don't expect the market to rise sharply too high or too low. So after, for example, as an example, imagine GBP USD is trading before a major CPI or inflation report. So before the news release, ATR is low, indicating cold market conditions. So you take a trade with a conservative RRR of 1.1.5 because the market is ranging. And after the CPI data is released, volatility surges and ATR jumps. Now you adjust your next trade's RRR to 1.3 or 1 to 4, allowing for larger moves with proper stop loss placement. If you see, especially if you see a very nice breakout in the market or very nice rebound from some key levels. So ATR helps us adjust risk-reward ratios based on volatility. No more fixed RRRs, guys. Okay, so next, let's say now gets more practical. We have talked about the importance of adjusting your risk to reward ratio dynamically, but how exactly do we do that? This slide breaks it down as I explained to you. So again, to make sure, ATR measures market volatility, so it tells us how much price typically moves in a given time frame. Instead of using fixed stop loss, we scale it based on real price movement. But there is another method as well to discuss, using dynamic support and resistance for take profit targets. Setting take profit targets without market context is a mistake, guys. So instead of arbitrary levels, align take profit with the strong support or resistance zones. As an example, for example, low ATR market, we have a ranging or sideways market, price moving with a clear range. Take profit should be set near the next support or resistance level, not at the random ROI level, okay? But another example can be a trending market. If price is breaking out, take profit should be placed at the logical next resistance level or a Fibonacci extension. I can show you a very nice example that happened just today. If we switch to gold market, you see, for example, on the 15-hour chart, first of all, you see how the market is ranging bound between the 29.21 and this lowest level at 2900, let's say, or 2909. Okay, so what we had in the market was the US CPI, and at the time of the US CPI, you see this very long candle here breaking above the last top, for example, here, and also this resistance zone here. So any of these places could be a good place to enter the market if you are a fast or quick trader. So okay, by the way, after that, if we want to set something like if we also look at the ATR, let me apply it here. You see how the ATR picking up from a very low levels, about the 70 cents, coming up to 2.8. So that case, when you see the ATR is almost about 80 cents, you can expect the price at the time of the news going above about 4 times, okay? Which is about the $3 to $4. And you see how the next candle, very next candle, just closed at this level. It's about the $4.23 pips, about the 5 times the current ATR in the market. So you see, this is how it works. So if you want to set your stop loss, for example, here, it's almost twice your ATR. ATR is about the 80 cents, and the stop loss suggested by the chart at this key support level is just the $2. So, let's say again, it's about the 2.5 times the ATR. It's a very healthy stop loss here, and it can be a very healthy TP here. So the RR of 1 to 4 or 1 to 5 can be applied as such a setup like this. But after that, when you see the ATR is taking the peak and then decreasing from this level, and all of these shadows suggest that the market is too choppy. So there is no clear movement in the market, but it's trying to make a lower tops and lower lows, but it's really risky. So in this case, you need to deal with the market in a different way. You have to set your expectations lower until you see a great pickup in the momentum of the market or breaking a key support or resistance level. So at these levels, even you are not a very good technical analyst, you see For example, you look at the market, you say, okay, below this shadow, I'm gonna sell the market, and then I will put my stop loss here is about the $2 away. And when you look at the ATR, it's about $1.31. So it's not even a 1.5 times the ATR, so it doesn't worth it, because any simple fluctuation in the market can hit your stop loss. So you're not gonna do that. You're not gonna take this trade. And you need to wait until you see a clear setup. It's about the, for example, again, $2, and you see still it cannot be a good place to set your stop loss. Maybe you need to set your stop loss a bit higher at levels like this. So this is how you see how ATR is working in volatile market and trading markets. I guess I explained too much. Yeah. So now let's address a critical flaw in many traders' risk management strategies using fixed stop loss in all market conditions. Why is that an issue? Why setting the stop loss is essential? We know that choosing the wrong type of stop loss can hurt your trading performance more than not having one at all. So let's break this down. Why is a fixed stop loss ineffective? You see, I'm trying to compare them together, what the market conditions are. This is things we are looking for. The problem is that, for example, a fixed stop loss means that the trader always sets the same stop distance, such as 50 pips or 100 pips, no matter what the market conditions are. So what is a problem to this approach is that the market conditions change constantly. So there are two key issues with fixed stop losses. High volatility markets, when the market is volatile after, for example, FOMC decision, as you saw after US CPI or any geopolitical events, price movements become larger, and a fixed stop loss of 50 pips can be too tight and gets hit easily, even if the trade ideas is correct. So in a low volatility market, in calm markets during the Asian session, before major news, something like that, price movements are smaller. So large fixed stop loss, your fixed stop loss can be too large for such a market. So it's really unnecessary and makes risk exposure too high. For example, you're going to short your USD during a slow moving session. ATR is only 20 pips, but your fixed stop loss is 100 pips, for example, way too large for this situation. So you could have used a much tighter stop loss, reducing your risk at least. But so this stop loss here is not proper. You need to reduce it. So if you want to compare this, you see on this table, a stop loss type, advantages, disadvantages. For the fixed stop loss, it's simple to use, easy to implement, ineffective, however, in volatile conditions, is a setback to that too tight or too loose. An ATR-based dynamic stop loss adapts to market volatility instead, reduces premature stop outs. However, it requires a bit calculations and more analysis. So see, fixed stop losses are easy to use but ineffective in dynamic market conditions. And ATR-based stop losses require some calculation, but they provide better protection and flexibility. I would say on real world applications, you saw how it works. As we are trading in the market to make money and really want to make it effective, I would suggest don't use fixed stop losses. So go always for ATR, compare your stop loss distance from your entry with the ATR and see if it's it's 2 times the ATR. That's something we can say is a safe let's say stop loss level. It's a proper stop loss, can be a shield for unexpected losses for you. But besides that, you really need to scrutinize a chart to define the levels of intense demand or supplies, the support and resistance zones. So that's a different thing that I taught that in my technical analysis courses. But here, the ATR can guide you in the market. And again, we have this formula for stop loss based on ATR. You saw how it works. For example, I have an entry price. My multiplier is 2, my ATR 30 pips. So I can just use this formula and I can calculate my stop loss by adding or deducting the 60 from the entry price, and to see if it's can be set with a key level, that would be a good stop loss. Otherwise, I need to switch to another time frame maybe, or I need to, let's say, wait more to get a proper trading setup, or I really need to avoid such a trade which is not suggested by the ATR, is not matched with the ATR. Because it should, the stop loss, the purpose of having a stop loss is reducing unnecessary losses. So the multiplier should reflect the market conditions, higher in volatile markets and lower in calm markets. You can choose it, and always evaluate whether the trade setup is worth entering by checking RRR, trend structure, and ATR behavior. And then mitigate ATR's limitations by using longer periods, support and resistance confirmations, and time frame adjustments. Now, so far we discussed all of this, but what is why having a proper stop loss matters to us? Okay. Why does this matter? Because even with the perfect stop loss, if you risk too much, you will blow your account. This is when we need right or proper position sizing, because if you risk too little, you won't maximize your trading edge. Let's break it down by starting. Let's see what is position sizing and why it is crucial. Position sizing is a process of determining how many lots, mini lots, or micro lots to trade based on your risk tolerance and market conditions. So we saw what we are doing here. First, we try to adjust to get to a flexible, let's say, stop loss level and flexible expectations on both sides, downsides and upsides. And then we are trying now to get to the flexible position size into market based on the chart and based on our flexible stop loss. So these actually come us to the position sizing. So it is the missing link between risk management and consistent long-term profitability. Because if you want to be worried about your stop loss all the time, you not gonna have time to figure out how much to make money. But what is a key rule here? Never risk more than 1% to 3% of your account balance in a single trade. This is what we have been saying repeatedly during our risk management courses, because 1% risk is for conservative traders or volatile markets, and 2% risk is a balanced approach commonly used by many hedge funds, institutional clients, and even professional retail traders. and 3% risk for aggressive traders or low volatility markets. What's the goal? To ensure that no single losing trade significantly impacts your account. And you see, the formula of the position sizing is very simple. First, it's the risk pips, or let's say it's a risk divided by pips at risk, and that's it. It gives you the volume, the amount of in units that you can trade. What is a pips at risk? Is the distance between your entry price and a stop loss. ATR based or manual, it can be twice the ATR, it should be, let's say it's more recommended. And what is a risk? Risk is the amount of capital you're willing to lose on the trade, which should not be more than 2 or 3% of your balance. What does it mean? It means, for example, if I look at here, my demo account, I have almost at $12,000. So if I want to risk only 2% of that, it's really easy, calculated by 240. 240 is the maximum amount of money I'm going to lose in one trade. I'm not willing to lose more than 2%. So in any scenario, in any market scenario trading setup, I have to set my stop loss. First, I have to find my stop loss, not based on my risk tolerance, but based on the setup of the chart, okay, and the ATR. And then I have to determine the size of my position based on my risk tolerance. So in this case, for example, let's say I'm gonna enter the market after seeing this higher bottom here and the RSI coming up from the oversold area, and then I have this breakout here. This is my very favorite setup here. And then the pip at risk I have is a distance from the entry to my stop loss, almost about the 30 pips. Okay, so I'm not gonna risk more than 240, but what does it mean? I have to divide this by the 30 pips. And what is the 30 pips? It is, see, we just counting in terms of the decimal places. And it gives me 80,000. I think why divided it to 100, which is a one standard lot, it's a 0.8 lot. So next time I want, if I, for example, I wanted to trade this setup here, I could set the 0.8, which means if I put my stop loss here and I'm wrong, I'm not gonna lose more than 240. That's it. It's a very, very easy way to calculate the size of the position, and it's a very quick way. Actually, I really recommend it to all of you to use and to practice, please, this one. Because there are other formula for that can get it a bit complicated or something, the time consuming to calculate, but here you have a very quick way to do. So how does volatility affect position sizing? It's very interesting. In high volatility markets, ATR is higher, stop loss is wider, so your position size should be smaller because my equity is fixed, but the market is constantly changing. So what I'm gonna do, I'm gonna adjust my risk, my size of my position based on the market conditions because I have a fixed equity. So when ATR is higher, stop loss is wider, so position size should be smaller because you see that's a fraction, okay, of the stop loss distance or pip at risk I have. As an example, you see, for example, let's say GBP USD after an interest rate decision, if ATR is 80 pips, a 2% risk means a smaller trade size to keep risk under control. In low volatility markets, on the other side, in a sideways markets, ATR is lower, stop loss is tighter, so position size can be slightly larger to get to the same result. Again, only 2% risk per trade. As an example, for example, trading USD JPY during a quiet Asian session, if ATR is 20 pips, the stop loss can be smaller, allowing for large position size while keeping risk constant. And the bottom line here is that adjusting position size dynamically ensures that your risk remains fixed and proportional to market conditions. Here are some common mistakes I would like to mention that before I close this webinar. First, using the same lot size for every trade is not recommended. The solution is always calculate position size based on a stop loss distance. The mistake two is that ignoring ATR and market volatility. Use ATR based stops and adjust your trade size accordingly. Mistake three is risking too much in high volatility. Reduce position size when ATR expands. Over leveraging in low volatility is mistake four. See, market is not volatile, so let me use more from my leverage, go bigger in the market in hope of some volatility, and just all of a sudden market can just turn around. So stick to fixed risk percentage, 1 to 3%. This is a solution for that conditions or that type of feelings that can sway you to do things wrongly. Even if ATR suggests a smaller stop loss, fixed risk percentage can save you. And final takeaways, I would say position sizing ensures that every trade has a controlled level of risk, and adjust trade size based on market volatility and ATR based stop loss distance. Use the 1 to 3% rule to prevent excessive drawdowns, and never blindly use fixed lot sizes. Let the market determine it for you. And I guess that's it. I think it's enough for today. That brings us to the end of today's session. We covered a lots of ground, from optimizing your risk to reward ratios in dynamic stop loss strategies and adjusting position sizing based on market volatility. So I want to sincerely thank each of you for attending and actively engaging in this session. The best traders are the ones who continuously learn, adapt, and refine their strategies. Keep analyzing your trades, apply these risk management techniques, and most importantly, remain disciplined in your approach. I can't wait to hear from your experience using these techniques in our next session. Thank you so much. Thanks again. I will see you in the next session. Happy trading, guys.